Welcome to this third episode of the ratio analysis. Here we'll study the second ratio of Dupont analysis, that is the asset turnover ratio and the activity ratios associated with these efficiency ratios. Here we'll cover what is the asset turnover ratio, the significance of asset turnover ratio in the overall financial analysis, the different ratios called activity ratios, that is the asset turnover, accounts receivables turnover, inventory turnover, payables turnover, working capital turnover. The method of computing the activity ratios, use of the activity ratios, cash conversion cycle calculation from the activity ratios, activity ratios broad range for different industries, features of activity ratios. I am Aninda Datta, the presenter. The second ratio in Dupont analysis is the asset turnover ratio given by the formula net sales by total assets. The asset turnover ratio measures the efficiency with which a company is using its assets to generate the revenue. The asset turnover ratio used in Dupont analysis considers total assets, as it uses the same asset figure in the third ratio to calculate the leverage factor. The total assets include the following assets: total fixed assets net of depreciation, gross current assets, which comprise the following, that is accounts receivables, inventory, and the cash in hand. The asset turnover ratios could also be calculated using only fixed assets in the denominator based on the data analysis needs of the company. The assets turnover ratio belongs to the category of activity ratios, which are a class of ratios used to measure the efficiency of a company in utilizing its assets and resources to generate revenue and cash. Now, what purpose does an activity ratio serve? It shows the productivity of a company in using its assets and resources. It uses a line item from the income statement, that is the net sales or cash collection, as the numerator. It uses a line item from the balance sheet as denominator, like accounts receivables or net fixed assets or accounts payable. As income statement covers a period, whereas balance sheet is at a specific point of time, so to make the numerator and denominator comparable, the average asset for the period covered by the income statement is considered as denominator. The average of opening and closing balances of assets for the income period is usually considered as denominator. However, the average could be calculated in a different manner also. Activity ratio could also be calculated for liability items like accounts payable as denominator. As activity ratios are multipliers, so higher the better if calculated for asset items, as high activity ratios indicate higher efficiency. The activity ratio is lower the better if calculated for liability item like payables, as it indicates better liquidity. Now, the asset turnover ratio could be decomposed into some commonly used activity ratios. Inventory turnover ratios. It is calculated by the formula COGS by the average inventory. This ratio indicates how many times the average inventory has been sold during the accounting period. Higher the inventory carrying period, lower is the turnover ratio. The company needs to do the following to keep the inventory turnover ratio high. Accurate sales planning, that is the market demand is forecast accurately. Accurate production planning, that is the company produces exactly as per the sales plan. The coordination between the two functions of the sales planning and the production planning. Receivables turnover ratio. It is calculated by the formula net sales by average accounts receivable. This ratio is a multiplier that indicates the number of times the average receivable has been collected during the accounting period. Higher the multiplier, it is better, as it shows good credit collection by the company. The company needs to adapt the following practices to keep this multiplier high. Doing the primary sales in line with the secondary sales to keep the trade stock to reasonable level. Efficient collection of outstanding credit. Encourage trade partners to keep up paid up stocks by paying good trade commission. Now, what is accounts payable turnover ratio? It is also an activity ratio, as it indicates how efficiently a company uses the accounts payable. Accounts payable turnover ratio is calculated by the formula equal to COGS divided by average accounts payable. This ratio indicates how many times the average accounts payable has been paid during the accounting period. Lower the ratio, better for the liquidity position of the company. However, too low a ratio is not good for company's business and reputation. The company needs to maintain an appropriate balance ratio, keeping in consideration the following. Negotiating good credit terms with the suppliers to ensure good liquidity. Paying the suppliers well in time to prevent disruption of the future supplies. The standard of payable turnover varies with the industry, so a company may follow industry standard. Some other activity ratios used by companies / financial analysts based on the information needs are working capital ratio. The working capital is the denominator. Turnover ratio of purchased raw materials or intermediate goods in order to track how quickly the organization uses the raw materials. Even equity turnover ratio is calculated to figure out how efficiently the owner's capital is used to generate revenue. Now, some of the activity ratios help in calculation of cash conversion cycle for the company. The cash conversion cycle for a manufacturing company refers to periods starting from purchase of raw materials to realization of cash from the buyers. Cash conversion cycle equal to number of days of inventory, that is raw materials plus finished goods, plus days of accounts receivables, plus days of accounts payable, minus days of accounts payable. As turnover ratios indicate the number of times an asset / liability is rotated, so dividing the days of accounting period by the ratio gives number of days of sales / COGS held as that asset / liability. Suppose receivables turnover ratio is 12 and the accounting period is 365 days. So 365 by 12 equal to 30 days approximately. So the average receivable is 30 days of sale, or the company takes an average of 30 days to collect the debts. Now, if the accounting period is half year, the turnover should be 6. Then the collection days remains the same, that is 180 divided by 6 equal to 30 days. So both ways it gives the same answer, even if we change the accounting period. Suppose the inventory turnover ratio is 6 and the accounting period is 1 year, that is 365 days. So 365 by 6 equal to 61 days. So the average inventory in all forms is 61 days of sale. Here sum of all inventory to be considered, that is raw materials, intermediate goods, finished goods. Suppose payable turnover ratio is 8 and the accounting period is 365 days. So 365 by 8 equal to 45 days. So the average payable is 45 days of sale. Here the company takes an average of 45 days to pay the creditors. Thus the cash conversion cycle or the working capital cycle equal to 30 plus 61 minus 45 equal to 46 days. Now, activity ratio values range are generally quite industry specific. That is, every different industry has a range of values for a specific activity. Now, inventory turnover ratio. Obviously, non-manufacturing industries like software consulting, etc. have very high inventory turnover ratio, as these companies do not need inventory for core operation. In the manufacturing sector, FMCG has a high inventory turnover ratio, as a range of 10 to 14 generally covers 90% of the companies. The capital intensive industries like steel, petrochemicals have relatively low inventory turnover ratio in the range of 3 to 5. The receivables turnover ratio. Industries where little or no credit sales are done and majorly cash sales are the norm have a high receivables turnover ratio, like retail, some FMCG companies, some software companies. Utility companies like electricity, gas suppliers have medium receivables turnover ratio in the range of 8 to 10, as some credit period is given to the consumers. The B2B capital goods industry needs to extend credit to the buyers, so have lower accounts receivables turnover ratio of 3 to 4 generally. The consumer durables industry has wide SKU range, so maintains high trade stock to avoid stock out. So have high accounts receivable and low receivables turnover ratio. Now, payables turnover ratio. The payables turnover ratio depends a lot on the supplier's bargaining power and the buyer's bargaining power. So it is difficult to associate payables turnovers range to industries. If the supplier is a monopoly supplier like distributor of proprietary items or supplies patented materials, then may not extend credit, causing high accounts payable turnover ratio for the buyers. The supplies of commoditized materials may extend more credit, so the buyers may have low accounts payable turnover. Fixed assets turnover ratio. The industry is relying more on inventory and tangible assets have high fixed assets turnover ratio like software, financial services, and consulting. The industry is relying more on inventory like retail, FMCG have intermediate range of fixed assets turnover of 5 to 10. The fixed assets turnover in retail depends on level of own real estate, and in FMCG it depends on the extent of own manufacturing. The capital intensive industries like utility, steel, shipping, airlines operate with a low fixed assets turnover ratio in the range of just 1 to 3. Now let's study some features of these turnover ratios. The turnover ratios are also called efficiency ratios, as those track the efficiency of using various assets. These ratios are very easy to interpret. For example, the fixed assets turnover ratio of 5 indicates $1 indicates in the fixed assets generates a revenue of $5 in the accounting period of usually say 1 year. The range of values for every activity turnover ratio varies with industry, so it is difficult to compare two companies from different industries using turnover ratios. The activity ratios are used more for comparison of different companies within the same industry or same company over different periods. Doing some arithmetical operation on activity ratios enables calculation of other important metrics like cash conversion days, days of purchase outstanding, days of sales outstanding, etc. Now, the macroeconomic variables have significant impact on the activity ratios, like fall in the interest rate in the economy prompts the companies to invest in more fixed assets rather than renting of assets like plant outlets, etc., thus reducing the fixed assets turnover ratio. Now the next video will be covering the leverage ratios. So thanks for watching. Have a good day.